up YouTube? Welcome back to my channel. So you want to learn how to day trade. Well, in this video I'm going to be showing you how I personally day trade and the strategy that I use to do so. So first up, what is day trading? I personally use this strategy that I'm going to show you today as a way to get into trades in the beginning of the day and get out of them before I go to bed at night. So if you're the sort of person that doesn't like to go to bed with trades open, then day trading might be the strategy for you. Now, this strategy is a combination of three things. Number one, market structure. Number two, a series of EMAs. And number three, Fibonacci. So if you know those three things, then you will be fine to learn and understand this strategy. It does involve a basic understanding of technical analysis already. So if you don't have any trading experience or understand what any of those three things are that I just said, I would probably advise that you enroll in a trading course first and learn the basics before coming back to try this. If you are looking for a good trading course, have a look at the first link below in my comments where I give you a recommendation for the community that I am a part of. So with that said, let's get into this day trading strategy. Okay, so here we are on the chart, and the first thing that we need to do for this strategy is set up our indicators. Now for this strategy, we only need 2 EMAs. With this strategy, you can change the length of the EMAs to suit you or to suit the coin that you're trading. I personally, at the moment, I am sticking with the 10 and the 20 EMA. This strategy does work exponentially well in a trending market. It's not the best in a sideways market, but I'm going to show you how to identify that throughout this video. So first things first, setting up your indicators. Just click on the indicators up here, search in the search bar, moving average, and you'll see exponential. Just click on that twice and that will just bring up 2 EMAs here. Click on the setting icon, change the first one. For this video we're going to change it to 10, and for the other one exactly the same and change that to 20. Okay, once you've done that, you will see that 2 lines show up. What I usually do from here, once they're on my chart, I like to just go back a little bit and have a look at how they have looked with this particular coin over time. And what I'm looking for is I don't want to see the EMAs cross too often. So see here how we crossed, the 2 lines crossed at this point, and then a little bit later they crossed again, but then we had this nice long run here and they didn't cross again till around here. So my advice when using this strategy would be to just pick a couple of coins that you know really well already and try this strategy with just those for the moment, and you can expand further down the track if you're having luck with it. Now, as this is a day trading strategy, we want to use this on somewhere between the 1 to the 4 hour time frames. I personally prefer to use it around the 2 hour, but 2 to 4 hour is ideal. Because the 4 hour time frame is more popular, I'll be using that for this video. Okay, so now that I'm zoomed into the 4 hour chart, you can see how things change a little bit, and you can start to see areas of choppiness and then areas of nice trend where you would want to take a trade using this strategy. Now, first thing I'm going to show you is when we would use this strategy to get into a trade, and then later on down the track I'm going to show you when you would not take the opportunity, just so that you understand the difference. Now, this strategy is based on an EMA cross. Some may call this a cradle strategy. It's not exactly. Cradle trading is when you trade when the candle falls in between the 2 EMAs. That is not what we're doing here. Now, our indication to get in is, at first, you'll get a cross. In order to not sit on the charts every day, I have my alerts set up to tell me when we get a cross. Once we get that cross, that's when I then come back and I'm going to grab my fib tool, which is here, and I'm going to place it right before the lowest candle before the cross. So that would be this doji here, and I'm going to draw it up to the highest candle right after the cross. So just to be super clear, you will get the notification. Once you've set it up properly, the notification will come once the bar has closed, and then you will come in, and so this candle here after the cross would be the trigger, and you'll most likely get the notification on this red one. So you would set your fibs to the wick of that red one, and you can drag it out a bit just so that you can be really clear where the numbers are. Now, at this point, I'm going to set my entry at 38, just a little bit above 38 fibs. Now, it can be anywhere between the 23 and the 38, depending on your account size. You can either do a staggered order, so 50% of your order at 23 and 50% of your order at the 38, or you can just go smack down the middle and hope that it picks up your order. So I'm going to grab my risk to reward tool, and I'm going to place it, this candle would have closed, I'm going to place it here, right in the middle of the 38. And then my risk to reward, I'll place still below previous structure. So depending on what that is, it can sometimes be a larger than normal stop. This one is 4.7%. All that means is that if you're leverage trading, you should not use a high leverage. But also if you're spot trading, then you would not, or either if you're leverage or spot trading, you would adjust your risk, you would adjust your contract size to make sure that whatever this amount adds up to is still only going to be a 1% loss of your account should it go the other way. So in this case, I'm going to leave it there. Now, where I initially draw my take profit is at previous structure, the previous high. So that would be here. So I'm going to mark it a horizontal line there. I usually don't include the wicks because I have more chance of price getting to here than a wick. So I'll have my initial take profit set to there. So this trade ends up being a risk to reward of 2.18 to 1. That's a pretty good risk to reward. So this is a trade that I would take. Okay, so now at this point, I have worked out my entry, worked out my stop and my take profit. I'm going to set an alert, another alert now to help me manage this trade. So about halfway through my desired take profit area, I'll draw another line. So it'll be about here. This is about the point where I would expect the price to get stuck, for example, because I can see candles have closed here a number of times and we've wicked up and come back down. So I'm going to set myself an alert here so that when price does get through that, I'm going to get an alert and I can come back and have a look. And at this point, I'll be using market structure to decide whether or not I should stay in. Now, the other thing to note is before you do take an entry like this, besides using the 38 fibs and the EMA cross, you also need to make sure that you have a change in market structure. Now, normally when the EMAs are trending, when they've changed direction, so you can see here the EMAs are sloping down, and you can see here they're starting to slope up. So normally when you have that change in the direction of the EMAs, you will also have a change in market structure because that's what they're designed to do. The other thing too that relates to that is that EMAs are a lagging indicator, and that actually works in this situation because the idea of this strategy is not to catch the tops and bottoms and to get the most out of every trade. So that's one thing you need to be clear on if you're going to try this strategy. You're not trying to catch the tops and bottoms. That is not how I trade anyway. And in this case, it's okay that EMAs are lagging because by the time they cross, it's usually around the same time that market structure changes anyway. So in this exact example, you could see here that price was trending down. Price started to change direction, and right here, if I draw it in for you, right here, we got a higher high, right? So we could see that market structure was changing. So the cross came, we got the higher high, we've got what we need market structure wise to get in. Okay, so we're happy with that trade, we're in it, we've got our alert set to check on the trade, and we come back. In this example, we've got a really nice massive green candle. You don't really have a reason to get out. Again, coming back to market structure, you would stay in this trade because you can see that you're starting to build a bull flag, but also the EMAs, even though they're starting to slope downwards, they haven't crossed yet. So unless they start to cross back the other way, there's no reason to get out. So from here, you would stay in this trade. You could reset that alert up if you wanted to make sure that it pushed straight through, or you could then move it up to the next area, which would probably be around here because of these candles, and you've got this wick here, and then you get your next alert around this area. Now, at this point, you can see that you're starting to get closer to your initial take profit. Would you get out now? Not necessarily in this particular case, and I'll tell you why. Because you have got such a huge slope upwards, such a steep slope, that this tells you that price is still trending upwards really nicely. Unless these two lines started to get closer together and then actually started to curve a little like this, that's when you would start to worry that maybe it's hit its top and you should take profit. Or take partial profit, or, you know, this trade is done with. If you're just happy with your initial take profit, take it, it's fine. But if you want to get a little bit more out of it, then watching what the EMAs are doing is a really good indication of whether this trade is over with or not. Now, moving on, say you decide to stay in, you would do exactly the same process all the way up. So you would have to, in this case, zoom out, possibly go to the daily just to figure out where is your next area to watch. So you're in the trade to here. You'd probably now move this one up maybe to around this area as your next alert, and you could probably move this one up as well. Let's just say somewhere around there. Okay, back to the 4 hour, and you could now probably stretch that up. As long as price does not come down and close below the EMAs, you can stay in your trade. So as you can see here, it's tested the 20 and bounced off, you can stay in. You've got another wick here, tested it, another one here, tested it. So until we close and open a new candle below, there's no reason to get out of this trade. So that would be your second reason to stay in. Don't forget, the first reason is watching the angle of the EMAs, and all this way up you can see that they did not start to angle down and they did not cross. So this particular trade, you could have stayed in all the way until you saw a change in market structure, coming back to one of the three things that we need for this. We're still creating them all the way up until here. So you could have stayed in this trade until this one was created and got out, let's just say somewhere, if you got out somewhere halfway through that candle, you still would have collected a 49% profit on a spot move, which is a huge trade. The other thing you can do is you can just accept to get out on the cross back of the EMAs. So down here we crossed the green above the red. Over here you can see now the red has crossed above the green. That could be your exit signal, and you could set that up as an alert as well. So in a trending market, works perfectly. When does this not work? Good question. All right, so this here is what we call a choppy market. And you can see here price is not trending up, it's not trending down, it's just going sideways. So when you see something like this is not something that you want to get into. Now, how can you know that without taking the chance? Well, it's really quite simple. It's looking at the angles of the EMAs. So this whole area here is very much sideways with the EMAs. You can see here that the EMAs are just doing this, which is very slight. There's not really an angle happening here. You want to wait until the angle becomes more definitive. For example, even this area is too slight, but you can see here, not only do they start trending upwards, but they also start to fan out from each other. So the fanning out, meaning the further away that they move from each other, is also a good sign that you're heading into a trending market. So just a quick recap on this strategy. Number one, market structure is important. If you get a cross, the first thing you need to do is make sure you have a change in market structure. Number two, you need to make sure you get the cross. Number three, you need to make sure you're sloping in a nice direction and you're not in sideways chop. Then number four, you need to draw fibs. All right, so now we have the strategy. You want to set up the alerts. As I promised, I would teach you how to do that. So go up to your alerts. Once you've clicked on alerts, you'll change the drop down to 10. So the condition is the 10 or your first EMA, whatever number you decide that to be. Crossing is in the next box, and in the last box it'll be crossing the other EMA that you've chosen, in this case the 20, once per bar close, because the EMAs can sort of cross and uncross throughout a candle, so we want to make sure that they've crossed after the candle has closed. And then you can write in here whatever notification you want, so you can just say day trade off. Once you set that first one up, this one here, if you have open-ended ticked or you just set a date in the future, that will go off every time the condition is met. And don't forget, this is a day trading strategy, so if at the end of the day, even if your EMAs haven't crossed, you can't move your stop into profit and you want to just close the trade, you can do that and jump back in when you get the next cross notification. It is that simple. All right, so if you are wanting to give this strategy a go, you can try this on any pair that you find, on any exchange. I personally recommend Binance. If you're wanting to trade futures, then I definitely recommend Binance Futures or BitMEX. If you want some more information on how to trade using Binance Futures platform, then just have a look at the link at the top of the screen somewhere for my video that gives you a full walkthrough of the Binance Futures platform. Until then, I will see you soon. Thank you for watching, and if you've enjoyed this video, please don't forget to subscribe and like down below, and also hit the bell notification so that you can be notified every time I upload. And please, if you feel compelled to, leave me a comment to help me grow my channel. Thank you so much, and I will see you next time.